How to avoid capital gains tax while flipping houses. By the end of this video, you're going to understand how capital gains applies to flipping, how to legally minimize what you owe, and how to structure your deal to keep more of what you make. Flipping houses is exciting until the tax man calls and says how much you owe, and it's not so much fun. So let's talk about how to avoid that. So I've paid a lot of taxes over the years, but I have found a lot of legal ways to avoid paying high taxes. In this video, I'm going to show you how smart flippers can avoid paying capital gains tax. So if you're flipping and you're not really thinking about taxes, well, you're leaving money on the table. I'm going to walk you through how to protect your profits the smart way. All right, a big question I get a lot is, Glenn, but what about capital gains tax? Well, the truth is, capital gains tax is actually less of a percentage than ordinary income, so you should be thankful if you could pay capital gains tax. So let's talk about what that means and how it applies to you. So what is capital gains tax? First off, I am not an accountant, nor do I play one on TV, don't even like talking about taxes, but I do know enough about it because I've been in the game for an awful long time. Capital gains means you pay tax on the gains of an asset. So you buy an asset, maybe a stock, maybe a house, whatever it might be, and then you sell it at a later date. Whatever the difference is from what you bought it for what you sold it for is called your gain. And you'll pay a percentage of that gain. That's why they call it capital, right? It was capital that you had, and your gain. So capital gains tax, that's exactly what it is. So why doesn't it really apply to a flipper? Because if you're doing it right, you should be in and out of a flip in less than a year. So you've not owned the house for over a year, so it wouldn't qualify for capital gains. Now, there are some cases where it might qualify for capital gains, but it has to do with your intent. And again, talk to your accountant to get more of a legal clarification on this. But if your intent was to hold a house as an investment for over a year and then sell it for a profit, then you get to pay the capital gains rate. However, if you have a flip that goes rogue on you and you have a hard time getting it sold within the year and it goes over, technically that's not a capital gain. Although one could argue that your intent when you bought it was to go over a year. So that's between you and your accountant, okay? Now, it's very different if you buy a rental property. If you buy a rental property and then sell it a year, 2 years, 5 years later, you'll be paying the capital gains on the appreciation that you received on that investment. In other words, if you paid $100,000 for a house and you sold it in 5 years for $200,000, well, in theory, you'd be responsible for the capital gains portion of the $100,000 that you earned on that property. So that's how it works in real estate. Of course, in theory, your individual rates can be different depending on a lot of factors in your tax qualifications. So while we're here, let's talk about some ways that you can actually reduce taxes on your flip, okay? We're talking about taxes, so let's talk about how to reduce taxes. If you structure your business in what's called an S Corp, so if you set up an LLC, then you're going to elect to be an S Corp, that'll actually lower your self-employment tax. It's much more efficient for high volume flippers. So what's a smart strategy for flippers when it comes to taxes? I recommend that if you are making income flipping houses, try to buy 1 or 2 rentals for every 3 or 4 flips that you do. That will help dramatically offset your taxes. Why? You can depreciate that asset over the next 27 years, or you can do what's called accelerated depreciation, or you can do something called cost segregation, which is something you pay for from a third-party service, but that can reduce your taxes even further by accelerating depreciation against the income that you made. Now, obviously, you have to talk to an accountant for all these things, but these are things you can do to minimize your taxes legally in the good old United States of America because we get paid the tax code. The tax code gives us a lot of breaks when we invest back in the infrastructure of our country. You just have to know how to use these things. Now, there's a big misconception here. People say, wait, so buy rentals, so take my profits from my flips and buy more rentals? No, I didn't say invest your profits, did I? I said buy the rentals. Now look at, we have a lot of videos in our channel about how to buy rentals using other people's money and how to build your investment using other people's money. That's what I recommend that you do as a real estate investor. Use other people's money to buy those long-term assets like rental properties. You still can depreciate the entire thing even if you didn't put your own money in it. The tax code's a beautiful thing when you know how to work it. So how do you find those rentals? Well, if you are searching for flips, you're going to find houses that'll be a good rental. Every so often say, you know what, instead of flipping this one, I'm going to go ahead and turn this into a long-term rental because it meets my tax strategy. It allows me to keep more of my flipping income, right? Think like a business owner when you're doing this. If you do, you'll be so much more wealthier in the long run. Okay, so when it comes to tax time, here's my recommendation. Don't go to H&R Block or some guy down the road that your mom knows or went to school with. Find a good CPA that understands deductions in taxes based on real estate and depreciation, accelerated depreciation, and cost segregation. You have to have someone that speaks the language. CPAs are just like any other profession. You've got the bottom of the barrel, the middle of the barrel, and the top of the barrel. Invest money in the top of the barrel accountant. I've always spent a lot of money on my accountants, and they've always saved me 5 times what I would have paid in taxes because I invested in the right accountant. So make that person part of your team from day one. You'll be thankful you made the investment. Keeping more of your profit means you have to learn how to buy smart. And that means knowing your rehab numbers and your ARV before you ever make an offer on the property. Go watch our video, How to Evaluate a Flip Deal Like a Pro. And I'm going to show you how to evaluate any deal so you can protect your profit and hopefully reduce your taxes from day one. The link is right here in the description.